Hello, everybody. Kirk Spano, Monday, December 2nd, 2024. Cyber Monday. So here's a Cyber Monday special for you. TradingView. You know that I use it all the time. I don't just use it for charting. I let it do the charting for me a lot of times with their algorithms and auto charting. And I use my favorite 8 or 9 or 10 indicators, and that's about all I use. So we get to do nifty things with the screeners and the charts. Love the screeners. And I will tell you the one that you need to buy. I have premium. I don't think you need premium. Plus is probably all you need. However, I mean, seriously, for this price, what I would do if I were you is I would buy the premium, and then in about 11 months, I would make a decision on whether you need to keep the premium or go to plus. It really costs you nothing to do the premium for a year. So do the premium, and then at the end of a year, decide, do you want to downgrade the plus to save some money? Essential's just not worth anything. I mean, essential is if you want to read other people's stuff and not do any of your own charting. And there's a validity to that. You get the screener, you know, and that's real important. So if you're not going to do your own charting and you just want to use the basic charting tools, I guess you could use Essential, but I think that once you get to the point of saying, hey, I'm starting to understand this or I'm doing this, you're going to jump up to plus or premium anyway. Premium has a whole bunch more indicators, and there's 2 or 3 that I use that are only in premium. So I would use the premium. Then in a year, if you're just not using it, then downgrade. The code is with the YouTube video, and at the moment it is in the chat room for the Zoom call. So go ahead and use this. I think that you will thank yourself. You will make your money back in one move using this software, guaranteed. And I can't guarantee things. All right, just a little thought for you. I'm going to release this article soon. Stop treating stocks like a high school crush. I've been having discussions with several people about trading, and I just want to make it very, very clear. If you think that you can be a great trader, then you should probably do paper trading for a very long time and see if you're right. Because most people who think they can trade, if you're not using the tools in something like this, you're not. Period. End of story. You're not. You're not a trader if you can't use TradingView effectively. So if you're not going to be a trader, that means you're going to be an investor. And an investor generally holds things for at least a year or two. Now, sometimes things get really, really good, really, really fast. You take some profits early. But for the most part, position trader, which is what I am, I'm looking to own things for 1, 2, 3, sometimes 4, 5, 6, 7 years. I'm not looking for, oh, I just made 20%. Oh, I just made 10%. Oh, I just made 20%. No, it's not worth my time. And I'm good at this. 90% of the money made in trading is made by the top 10% of traders out there. It's just like poker. In poker, the top 10% of us make all the freaking money, and everybody else loses. There's a handful that break even, but pretty much everybody else is just on the slow glide path down until they realize after 3, 4, 5 years, gee, I've put all this money into trading frequently and it just hasn't paid off. That's because you are up against guys like me, and then there's people who are better than me. Think of all the prop traders that are out there. Then think about all the prop traders that got so rich at a young age that they're retired at 40-something years old or 50-something years old, just managing their own book. So you're trading against me. You're trading against the prop traders at the institutions. You're trading against the retired prop traders who have enough money and capital to do what they want. Most importantly, you're trading against the supercomputer algorithms and all the various liars, cheaters, and thieves in the dark pool markets. So if you think that you're going to be like Shooter, then you better get over to Rare Investing and have Shooter mentor you. Because if you're not going to make that commitment to having a mentor and learning how to really trade, don't do it. 90% of us can make money by buying low, going to do something else for a while, something productive with our time, and then coming back when the traders have changed the narrative, bid something up higher than it probably should have been, and then you sell it to them. So AST Space Mobile, I told you it wasn't very risky at $5 a share. Now it's $25 a share. Somebody asked, should I still buy it? Yeah, you should still be buying it. But is it more risky today, or was it more risky at $5? It was clearly less risky at $5 a share than it is at $25 a share. right? That's the whole definition of margin of safety. Yeah, but the company did other things. No, I knew when that stock was $5 a share what was going to happen. Why? Because I read everything, right? I read everything. I knew a year ago and 2 years ago what everybody was going to be talking about today. I knew what the narratives would be. And that's what you got to do. You have to learn ahead of time, because most of the people in the market, especially the traders, they're just trading charts. They have no idea what they're doing when it comes to the fundamentals of a company. They just grab the narrative that works in that moment. Oh, look, it's going down, so it must suck for this reason, this reason, and this reason. Oh, look, it's going up. It must be awesome for that reason, and that reason, and that reason. If you do the reading, if you learn ahead of time, you're going to be able to buy companies like Rocket Lab at $5 a share. You're going to be able to buy companies like AST Space Mobile at $5 a share. You're going to be able to buy Palantir at $9 a share. You can buy NVIDIA way below the split adjusted $20-$25 price. We bought NVIDIA for the very first time when it was like $8 or $9 a share. It was dirt cheap. But Micron below $20 a share. So if you actually do the reading and you buy things when they're cheap that you know will be pretty good in a few years, eventually the market brings it up. Then they tell the story that you knew was coming, and you make 3, 4, 5, 600% on your money every few years. Now, is it going to work with every single stock you pick? No. Why? We're fallible. We make mistakes. Executives make mistakes. That's usually a bigger problem. New competitors come in. Happens all the time. But if you buy a whole bunch of stocks that could go up 5 to 10x or 20x, and you buy them cheap so that your downside is, 20, 30, 40, 50%, and you're smart enough to bail on companies that aren't executing, or a new competitor came in or whatever, and then you ride the other ones up 3, 4, 5, 6, 7, 800%, you crush the market. You make probably double what the market makes. In my career, I've made about double what the market makes. I didn't do it by trading a lot. I didn't do it by going, oh, I'm going to wait and see. I'm going to wait and see. I'm going to wait and see. No, I learned what other people were going to see later. And that is the simple lesson of investing. Warren Buffett has written pages and pages about it. He's given speech after speech. He's given interview after interview. Do the reading. Think about things like you're the CFO and the CEO of the company, and then ask yourself, can I make a whole bunch of money on this company by running it? CEOs, CFOs, vice presidents, what do they all want to get? What do they all want to get? One word. Starts with the letter P. What does every executive in the world want to get? Bueller, close, Jim. Bueller. What do they all want to get? Starts with the letter P. No, come on. What do they want to get? What do they want in their money? What do they want? They want to get paid. Are you guys messing with me? Every executive in the world wants to get paid. And if you don't think about that first, you're going to be a shitty investor. Every executive wants to get paid. Figure out how they get paid. Follow the money. If they get paid because they get that stock price to go higher, then figure out what they have to do to get that stock price to go higher, because that's what's going to happen. If you want to know how the world works, Grandpa, you hear me? If you want to know how the world works, follow the money to the people who are getting paid, because that's what's going on. So read everything. And when you find a good stock, you go, okay, their price is low right now. Their growth is about to ramp up because they're getting close to the end of a CapEx cycle, or because you can see the sales already increasing, or you know that they have a significant edge on the competitors that they leapfrogged, whatever. They have an asset that the market completely misses, usually real estate. And then you buy it cheap and you put it in your account and you don't look at it every day. You can read from their corporate documents, read things from the industry journals, follow the industry, but don't go, oh, it's red, it's green, it's green, it's red, it's red. Oh, it's red and green. Should I do something? Click. Get over your zucking self. If you think that's how you're going to make money, clicking that button, because you're not. 9 out of 10 of you cannot do it because A, you don't have the training, B, you don't have the time, C, you don't have the temperament. And really that middle one, time, you can't be a swing trader with less than 25 hours a week to spare. And even if you have that time, you are up against some of the sharkiest sharks in the world. So Let all the pretend traders push something way down because they're following a narrative that some hedge fund or some bigger guy planted that he's going to take profits into, and then buy it cheap from all the people who are petering out. And then when some hedge fund or private equity guy plants the new narrative in all the little trading rooms and all the little Discord rooms and on Twitter X, and you start to see it go like this, and then it starts to click up a little bit, and you go, oh, I'm gonna wait for it to go back to its low. No, buy it. And then over the next few years, sometimes faster, sometimes slower, you're gonna make a whole bunch of money while you're playing with your grandkids, while you're jet skiing, while you're golfing, while you're taking your honey to dinner, right? You don't need to trade a lot to make a lot of money. The best traders in the world, the best investors in the world are position traders. George Soros, oh, he's evil. No, he's not. He's one of the best people that's ever lived, probably. And he's a spectacular trader. But does he go in and out day to day? No. His trades are position trades measured in quarters, if it works out for him fast or if he thinks it's going wrong, but usually in a few years, because he'll buy something cheap today, in the next year, 2 or 3, it'll be a lot more expensive, because the narrative that's happening later, he could read everything and go, oh, well, this is going to probably go in this direction in about this time frame to about that magnitude. And eventually, all the know-nothings, or as Jim Rogers would call people, flunkies, all the flunkies go, oh, it's going up, I got to buy it. It's up 500%, I got to get the next double. Meanwhile, guys like me are selling into that last double. Oh, you're dumb. It's going to go up another 20 or 30 or 40 or 50%. Yeah, but I bought it 500% ago. So I can dramatically reduce my risk by selling into that last double, scaling out on the way up, because you don't know when it's going to hit a peak and crash. If you think you know that, I don't know why you're watching, because you're a zillionaire. So buy it cheap. Money is made in the waiting, not in the trading. The stock market, and people who are paying attention know I'm just quoting other people. The stock market is a mechanism for transferring money from patient to the impatient. For every one person that gets rich quick, there's 97 or 98 that lose money and don't. It really is that big of a proportion. It is almost impossible to get rich quick. You have to make a huge option trade on something that goes up in the next month. You have to make a huge futures or options trade on something that crashes in the next month or two. It's almost impossible to time. Not impossible, but almost impossible. I mean, you're looking at 98 or 99 to 1 against odds that you can make that trade. So why not find 20 or 30 really good stock ideas, and the ones that start to execute and go in the right direction, pyramid up. Add to those positions on the way up. Pyramiding up is an awesome strategy. It works because you're an early investor, you're still an early investor, you're still an early investor, and as the inflection point gets there, you've got a big position by then. And then all the FOMO people and all the people who have to tell a story to justify what they're doing, because they don't really know what they're doing, pushes the price up way higher than it should be. Now we take a look at AST Space Mobile and Rocket Lab. Rocket Lab's still moving pretty good. AST Space Mobile's been chopping around in a range now for 3-4 months. So it went from 5 to 35, and now it's in the 20s. That's probably ABC 1, 2, 3. It's just a correction. As they get to the point of launching more rockets, getting more satellites in space, starting to get some revenue in 2025, and starting to have a lot of revenue in 2026 and 27. At about the same time, their CapEx will fall off a cliff, because all the satellites will be up there, and now they have 5 years where they just basically have to maintain them. You know, they'll send something up as a replacement here and there, but they don't have to put the next big wave of satellites up for 5 to 10 years. I know that. Most of the market doesn't know that. You still have all the Musk fanboys who want to bet against AST Space Mobile. At some point, they're going to get blown up. Back when I was growing up, there was a phrase, and maybe it existed long before me, but there was some music around it, cult of personality. There are cults of personality all the time. And if you buy into them without really knowing what they're all about, you're going to end up with a problem. So I don't really do a lot of hyping. How often do I pound on my desk? How often do I pound the table? Not often. But people who are out there repeatedly saying something over and over and over and over and over again usually have an agenda. It's usually not good for you. Now, you can try to ride along. You can be the pilot fish on the shark. And sometimes that works out until the shark decides it's time to turn around and eat. Listen to Jim Rogers. Listen to Jim Rogers. Read everything. Find your 20 to 30 good ideas. A handful of them are going to go through the roof. A whole bunch of them probably beat the market. And the ones that end up being stinkers or chopping along because they can't execute or the time frame introduced competition before they could take off, you get rid of them and put that money into your winner. One of the biggest mistakes that I've seen in my career is people that buy frequently on the way down. Oh, look, Planet Labs, public at 10, bought it at 8. Then there's people who bought it at 7, 6, 5, 4, 3, 2, 1. And they're so heavy in Planet Labs that maybe they're just getting the even right now. Maybe. And a lot of stocks like that. If you're going to scale in slowly, small at the start, and at very wide price point. So when we take a look at some of these stocks that I bought at $7 or $8 a share that went down to $1 or $2, you'll notice in this case of Spire Global, and I'm just talking about space stocks because they're on my mind. I bought that one in the 7s, and I didn't buy it again until it was around $1. But why not 5 and 3? Because it was still going down. Catching a knife hurts. You ever watch the show Vikings or Valhalla or the new one, The Last Kingdom? Anybody who tries to catch a sword, it hurts their hand. Oh, look, he's a tough guy. He just grabbed a sword. Yeah, he just cut his hand off. TV, folks. All right, so I'm going to write this one. It's already kind of written. So you go to TradingView. I have my list of ETFs. There's about 80 of them, right? 84 of them. And I want to sort using my weekly technical charts, right? See, it says 1 week, 1 week, 1 week. These are all based on a week. The measurement is at the end of the day on Friday. I don't measure every day. I don't measure every couple hours. I don't care. I'm looking for longer term, more sustainable trends to give me a hint that I should spend some time reading. And that's what technical indicators do. They give you a hint. Hey, something looks like it's going on here. There's some smart money or dumb money doing something. Let's get educated. So the Spider Select Technical Fund is on a technical buy rating, a moving average buy rating, and the oscillator is still saying buy. I wouldn't buy this right now, but if I owned it, I could hold on to it for a while. And in the 401k plan that I manage, I own technology and QQQ. Interestingly, let's take a look at QQQ. Take a look at, one of the few ones that I actually have annotations that I want to keep. Take a look at where this has gone from 2019, 2018, 2006. That's a hell of a rally. Let's really focus on since 2020, COVID. 1, 2, 3, unless started here. I keep talking about that bottom in 2016 as being meaningful, and that COVID wasn't really meaningful, except that the bailouts amplified the ups. We know that when liquidity speaks, sentiment listens. And for the last few years, the market has been very liquid. Right here, that was the Fed trying to make the market less liquid. And then it allowed the market to get more liquid because it cut quantitative tightening into the election, and the market went up. At the same time, there was all kinds of fiscal stimulus. What is the new administration talking about doing? Getting rid of a lot of the stimulus. And inflation still isn't down to 2%. And what did I explain to you is the most important thing the Fed is looking at for interest rates? There's two things, actually. The first one is interest on the federal debt. Now, people think that's a bigger deal than it is. 70% of the interest on the federal debt gets paid to America, a little bit more than 7%. So it's really money from the left pocket into the right pocket. A little less than 30% of the interest that we pay on our debt goes to foreigners. Most of them are allies. The exception, China, which I think has 9, 10, 11% of our debt. So when you take a look at the markets and you ask yourself, okay, if this is a great example of liquidity drying up, or COVID is a great example of liquidity drying up, what is really the most important question we should ask? What does liquidity look like over the next year or two? We have a wall of debt maturities coming up in 25 and 26 because Janet Yellen wrote shorter term bonds rather than longer term bonds at higher interest rates. So rather than locking in debt at 4 or 5% for 10 or 20 years, she only locked it in for 2. And in 25 and 26, big wall of debt coming due. What is the most likely outcome? That they roll some of it for 2 years, but that stress in the market forces interest rates down at some point. But if there's inflation, that limits what Jerome Powell can do at the Fed. So you're going to have two different forces meeting each other. The forces of we have to refinance this debt, we prefer not to do it at 5%, versus we need interest rates low enough that we don't cripple the build out of the economy. We have seen a huge build out in industrial, manufacturing, and logistics over the last 4 years, really the last 3 years. It took a year to get things rolling. Residential built for a few years, and the completions in 2025 right now are very low. And in 2026, they're even lower. If interest rates tick up in the next 6 months, we're going to have a problem with real estate completions, especially on the residential side, and even on the industrial and logistics and manufacturing sides in 2026. They'll be lower in 2025 because not a lot of new residential projects started in 2024. Why? You heard me talk about the private equity deals I was trying to get involved with. Internal rate of return wasn't high enough because interest rates were too high. They just got to the point before the election where it looked like we can finish up these deals. We can break ground in spring and summer of 2025. And that means a lot of those projects will be done in 2026. So the chart ends up working out. I actually have that chart somewhere, and I'll stick it in an article at some point. I will try to find it. One moment, please. I look at Twitter X, and I just see that people are posting literally 10 times a day, 20 times a day. What are they doing with their time? I mean, a serious question. What are they doing with their time? I'll find the chart for you, and I'll put it up. But basically what it shows is that there was a big spike in completions in 2024, which I told you about quarters before it happened. Rents stabilized, but in 2025, there's almost no completion on residential real estate, apartments, condos, and like that. So that means there will be upward pricing pressure on residential real estate at some point in 2025 because there's not going to be enough supply. We have to fix that by 2026 or it becomes a really big deal. But if interest rates go up in 2025, then it's a big problem in 2026. So what will be the response from either Jerome Powell or a new Fed chairman in the spring of 2026? Dramatic interest rate cuts, which is why I pointed out that the intermediate term treasury, which is up in the 4s right now for yield, you probably can make some capital gain over the next couple of years. So if you're looking for a safe place in the very short term, money market is fine if you don't care about capital gain because you're getting 4% or higher. But those intermediate term treasuries are a pretty good deal. And if interest rates go higher, then suddenly TLT finally becomes attractive, right? So if interest rates go higher, then TLT will probably come down here and get close to a double bottom, and that's your signal to buy, somewhere in the low to middle 80. It becomes recession insurance. That is what TLT is. TLT is recession insurance because if you can buy it down here, and then suddenly we're in a position a year out where they have to slash interest rates because everything's broken, or they just want a sugar high, then it goes way back up here. And you've suddenly made a 20 to 30% capital gain on a bond, probably at a time when stocks have been going down for a while. So that's your recession hedge. Why am I talking about this now? Everything's great. I've been telling you a long time, 2025 and 2026 looked weak to me. And at the end of the decade, 29, maybe 28, maybe 30, looks horrific. There are spots to make money for a few years at a time. Position trading work during those windows. People who are buy and hold forever, they might round trip over the next 6, 7, 8 years. People in the S&P 500, they might round trip over the next 5, 6, 7 years. People who are selling options on the regular, probably going to do well. People who understand that they should sell something from time to time into massive strength, like Buffett is doing right now and has been for several months, several quarters, get ready for the day when everybody runs screaming for the hills. And if you have cash or bonds that are appreciating, you can turn around and buy equities and real estate on the cheap. I'm not telling you that it's right here, right now. I think the chart is going to look like a roller coaster. We're ticking up right now. We're going to go over, then we're going to get a little rebound, and then we're going to go out over the edge. That's the short story, too long didn't read version. What I think the next 5-ish years looks like. A little bit more rally in the next year, then it's going to get choppy, probably going to get a correction, might even be a bear market. Won't be a huge 50% bear market though. It'll be 20-ish percent, 25. Maybe it doesn't get there, maybe it's 15. Then you get your blow off top because they're going to cut interest rates, they're going to deregulate, they're going to let private credit go crazy. They're going to let the finance guys do what they want to do, which is turn everything into hot money. Then at the end of that cycle, 4, 5, 6 years out, it'll crash. You won't blame the people who made it happen. They'll blame the people who are standing there right now like deer in the headlights. I've told this story before in my career, and it's happened 3 times. One time it got obscured by COVID. I'm telling you, it's coming again. Between now and then, you have to be cognizant of what your real risk tolerance is and understand that not everything goes down. Certain things get the rotation to them instead of away from them. Treasury bonds might be one of them at some. Again, if this comes down towards the double bottom, it'll be hard not to buy it. Valuations are through the roof again. Liquidity looks like it's going to be tough for the next year. We need a low interest rate shock, right? Where we just suppress interest rates so that we can refinance everything and then sugar high it. Now, my opinion, and I've written this article about the great normalization, I thought we were on the right path, and now we've changed path. We'll see what happens. My guess, if the last 3 times that this was done happens again, the outcome will be the same. You deregulate, you cut interest rates, you cut taxes, you get a sugar high rally that lasts a few years, and then when the last money is in, when the dumbest person puts in their last dollar, rich guys all sell, and it crashes. What do we know that's been going on for the last year? The rich guys have been selling, correct? Massive insider selling. Palantir, Nvidia, Amazon, pick your company. Billionaires have been selling into this strength. That has never, ever been good for retail. Ever. Never. Not once. So we have to be very careful. And, we want to get the last puff on the cigar if we can. But we have to be very careful in the next couple of years. Probably going to get a buying opportunity. And then several years out, we might have to sell almost everything. We'll see. So YOLO is the one that popped up as a potential buy, right? The oscillator is turning up after a long period of being on a sell signal. So here you go, it crashed, and now it's been going sideways. I won't buy that. Why? Why won't I buy this fund? It's too diversified. Honestly, it's too diversified. I don't like most of the stuff in it. It's not structured well either. I won't go into that, but it's not structured well. The red line is my cannabis stock. It's a REIT. It pays out a 7% dividend that we bought way back here, wrote it up, sold it, bought it again back in here, wrote it up. It's on a little correction right now. One of the only times that I'll look at a daily chart is I'm like really close to wanting to buy. And about a week ago, because I talked about selling puts on this, I sold some puts. Take a look at the last 1 year. That switches it to a daily chart. Notice that the ETF just doesn't do well compared to this company. So let's just look at innovative industrial. You got your rally. We bought it in the 80s, correct? There we bought it in the 80s. Any of you get it in the 70s? Maybe a couple of you did. But we got our Wyckoff spring signals. We've got a couple more. And then here we go. We got another Wyckoff spring signal to buy. And it started going up. But what if I told you about these? They indicate direction pretty good, but not magnitude. So it could be a short rally or it could be a long rally. Other indicators will tell you that. Looks like it's going to get back up into here, 120s. Not a huge gain. But if you were looking for a dividend pair, I think it's something that you can buy. You can augment your income by selling covered calls as it gets to these resistant levels. As it gets close to 120, probably sell a covered call in the 130 area. And that's the extent of the trading I do. When do I take a little money to put it in my pocket and then hope that volatility goes my way, which is using these indicators, 2/3 likely to go my way. So very meatloaf-ish, right? Very meatloaf-ish. 2 out of 3 ain't bad. So here we take a look at the RSI on the week. Bottomed out here, right? Bottomed out. This was oversold. You got your blow off the red lines, or your blow off bottom. And you have to learn how to read all this stuff. Not going to explain it every single. But look, that spring, this is your shortcut. Just pops up. Wyckoff pitchfork shows the longer term trend. You may not get all the way through that trend area. If it does, it'll be a breakout. I don't think that's going to happen, but it might. They'd have to get good legislation because we read everything. We know what actually would make this company go. But if you're a dividend investor, and the fact that people are not going to stop smoking weed, and this company will continue to pay out their dividends, even if they don't have more growth, maybe their growth period's close to done, you can still make 7%. You buy this, and every now and then, when you get to a resistance level, sell a covered call. And then maybe you get a little jitterbug down, and you can buy your covered call back, or it expires. So if you go to the stock screener and take a look at the Russell 3000 on the weekly technical, we're going to rate this by where are the buys. If you see the RSI is low, below 50, some of them are below 30, but not a lot of them are going from sell to buy. And in this macro environment, I want to be real careful. So these are not automatic buys, and I don't know anything about a lot of these companies. This is the Russell 3000. Which is the 3,000 biggest stock, including the S&P 500. So what are we expected to see at the top of this list if I flip it over? All sorts of big companies. An article that I'm writing right now is it's time to sell the big bank. JP Morgan is the one where I think you could sell covered calls. All the other big banks I would be a seller of, every single one, especially Citi, especially Bank of America. You go through here, you go, okay, here's one that I know some of you still own, Kinder Morgan. What price range did I tell you to sell it at when it was 13, 14, 15? What did I tell you it was going to go to? Middle to upper 20s, correct? There you go. If you want to hold on to it because of the dividend, fine. At least sell a covered call. You won't get much for it because it's not a lot of premium there. But the buy signal was way back here. See, this is a time frame when I was telling you to buy it, even further back. I was buying this one a long time. Now, tell me, the same people that were telling me I was stupid back here, now that I'm saying trim it, sell covered calls up here, are the same people telling me I'm stupid. I'm okay with it. If you own Kinder Morgan, sell covered calls or trim back your position. You've probably made 50% or more on your money. Some of you might have doubled your money. If you've doubled your money, just sell half. Find a different place for this. Or set limit orders or sell cash secured puts if you can get any premium so that when it gets into the lower 20s, and I'm almost positive that it will, you get it back. And you create that $5, $6 gap between you and the market. Now, you're not going to get any premium for a $20 or $22 or $22.50 put right now, but if it comes down, you will. So game plan it. Trim some up here, sell some covered calls, and then when it gets back down here into the low 20s, say, hey, I still like that dividend. I'm going to buy it back or sell some cash secured puts. But on dividend stocks, a lot of times you sell the cash secured puts beyond what you really want to own because you know if you get it down here, that's super cheap. But usually you just buy it back because it pays a dividend. As you go through this, you start to see, is there kind of a pattern here? What do you see? This is the end of a bull market. That's what that is. All kind of looks the same, doesn't it? Numbers in the 70s and 80s. PayPal's holding on, but I think PayPal's probably gearing up. It's been a long time since we looked at this one. I still have the old drawing, 5-year. This is a stock that I bought at the IPO. I sold it between 100 and 150. I was wrong. I bought it in the 30s. I sold it a little over 100, tripled my money, and I was wrong. I should have bought it back during the COVID crash. I think maybe we had a little bit of it, but didn't get to ride that rally. Now it's down here, and I mentioned it 4, 5, 6 months ago. It's had a little rally. Take a look at the 1-year chart, and you ask yourself, what's the upside here? Well, I think the upside is 100-ish, a little over 100-ish, based on what I know about the company. And I think that's probably what they're looking for in a buyout. Because why? Why would executives sell PayPal? To get what? Paid. Change of control bonuses, golden handcuffs, golden parachute. Is there a trade here for the nifty swing trader? Probably. Is there a position that I want? No. If I was going to buy this, I would have bought it way back here. I don't want it anymore. I think that if you can sell covered calls to between 90 and 100, February, March, April, I think that's probably a pretty good deal for you. And you just keep scrolling down, and it's the same pattern, right? Not many stocks, and some of them are just going nowhere. I'd like to show you something. Everybody wants to talk about REITs. You got all these REIT guys on Seeking Alpha and all over the place. REIT. All right, I'm going to show you something. We're going to change this to all. Go all the way back to the financials, or to the .com. And we're going to pick right at the end of .com, so 1999. We're going to add SPY. We're going to add QQQ. Adjust this to show the total return. Let's actually go back to the financial crisis. There you go. Since the financial crisis, realty income has trailed, and remember, this is inclusive of dividends, QQQ and SPY by a lot, right? So realty income made, SPY, QQQ. We have that right. All right, this is inclusive of the dividend. Just barely, depending on where you measure from, right? There's some spots where it basically tracks SPY. So realty income or the S&P 500, right? They basically return the same amount. Where are you safer? Are you safer in realty income? Or are you safer in SPY? It's actually a hard question. I wouldn't own either one. I think you're at high economic risk in both places. And I think QQQ, despite being the best companies in the world, is probably overvalued. Probably needs to come down to here, which coincides with its channel and that top. So I think you need to be very careful about buying almost anything. This screener shouldn't show this pattern, right? Everything is turning over. Everything is decelerating. That's what the oscillator is telling you. Fractal. It's the moves within the move. It is the shape of the curve. Is it bending up or is it starting to turn over before it goes down? Lots and lots of things. Teresa was talking about a breakout in Planet Labs a month or two ago. She said it would, and this is basically from a few months ago, she said if it broke this line, it would break out and get to about here. Well, it's there now. If you're even on Planet Labs right now, you need to ask yourself a question. What do I think about the future? Well, what I think about the future is the stock goes into the upper single digits. Maybe it gets to 10 again. I think it's a buyout candidate. I don't think it has a lot of downside from it, but we're going into that last double period. So over the next few months, I think you pretty much should be managing your risk on Planet Labs because it's in the last double period, in my opinion. I can be wrong. Maybe there's a triple in here yet. But when I talked about this on Stocks on Spaces, it was right about $3 a share. And I said, I'm not super excited about Planet Labs anymore. A lot of competition. They said, well, then why do you own it? Yeah, it's probably a double or triple from 3. And now it's almost doubled. So I'll talk about it on Stocks on Spaces on X, either Tuesday or Thursday. It depends when I have time. I think Thursday. I usually go on once a week, either on a Tuesday or Thursday. I'm going to try to do twice a week, but it's tough. And it's having that rally right now. So I'm going to update them on the rally. I'm telling you first, selling covered calls right now probably isn't a horrible idea. So the stock is about $5.50 right now. That's up 50 cents today, give or take, right? Is that right? Planet Labs up 15% today, up 60 cents. Is $4.53. So we can use the shortcut method. We'll use the shortcut method over at Yahoo, which they're putting in a new community tab. I'm a charter member, so I will be one of we're in the alpha testing and getting ready to move to the beta test before the launch sometime in 2025, a new community section that's not all garbage. I think it's going to be the best one on the internet. I think it's going to be better than Twitter. Anyway, covered calls. You can sell a January 750 covered call and get 55 cents. That's huge. That's over a 10% premium. Still allows the stock to run up to 750, which gets towards that buyout price that I'm talking about. Why is this so expensive? It's because you have speculators in there now. You have momentum in there now. You have chasers in there now. Sell a covered call on Planet Labs, the January 750. It doesn't have to be against your entire position, right? If you want to hold on a little bit, see if it goes to the moon, that's fine. But I would write this against at least half of your position, probably 2/3. That's a big premium. Annualized basis, that's huge. Take a look at Black Sky. This is another one that Teresa talked about back when it's down here. She told us where the breakout would be. It's breaking out right now. Right? It's down a little bit today. And I think that you could look for about a $14 or $15 covered call, just eyeballing it. Let's see what the January $15 covered calls look like. 75 cents on the high side, 60 cents on the low side. Over a 5% premium. I guess that would be 5. So almost a 5% premium. You probably won't get 70, but you try. Remember, always put in your trade at the ask, right? Because that's the most you probably get. And if it doesn't execute every couple of minutes, I usually do every 20, depends. I walk downstairs to get some coffee or something. Lower the nickel. Go do something else. Look something up on Perplexity and lower the nickel. Eventually it'll hit. So I like selling covered calls on both Black Sky and Planet, not against your entire position. You have to do you. What are you in it for? But I think that both stocks have limited upside. I think we're into the last double on these stocks, which means you should be thinking about scaling out strategy because the higher it goes, the riskier it gets. And you don't know when, who knows, one of their satellites crashes or the government says we're not going to use you anymore. You don't know. So you scale out because there are plenty of unknown. Finally, somebody posted this, I think Les, did you post this in the chat? Great piece. Take a look at it in the chat room. I'll put this up at Fundamental Trends. It's in the Seeking Alpha chat room. Talks about the global natural gas market, liquefied natural gas. Liquefied natural gas is cheap right now, and I think that those companies are going to start minting money in the next couple of years. And of course, we have New Fortress Energy, which is completely beaten up now because of different factors. And there's a couple of secondary plays that I like. Ametis being one of them, the renewable natural gas. Anybody who adds cheap natural gas into the supply is going to do well. Anybody who can transport it on the cheap is going to do well. Not so much the pipelines. They don't move with price, right? Pipelines are fixed contracts for the most part. Over 90% fixed contracts. Price movements don't matter much on natural gas. The pipeline. But companies like Coterra, like Permian Resources, like Ametis, like New Fortress Energy, a lot of these companies are undervalued right now. Don't chase the ones that have already gone up. Don't buy the ones that the old men are buying or that they've been holding on to for 30 years because grandpa gave me this stock and I'm never going to sell it. I'm going to die with it. And if you inherit some of those, if you inherit Exxon or Chevron or some of those companies, sell them. Just sell them. Pick something else out. It's time for you to take that step up in cost basis and hit the road. But there's other stocks out there that are going to do really well in this developing natural gas market. And solar is going to do really well. So the prices on solar are so beat up right now that you can't help but buy and Enovix, which is going to have battery solution. You can't help but buy Complete Solaria, which is basically Sun Power, but 99% cheaper than what Sun Power was, right? Coming out of bankruptcy. Will the company grow 30% a year? Actually, it probably will. But what is the narrative right now? The narrative right now is Trump's going to destroy solar, destroy clean energy, blah, blah. It's not going to happen. Prices have gotten destroyed. We have a huge need for more energy. Otherwise, we can't have AI, especially if AI gets smart and decides that we don't have enough energy, decides to eat us like they did in the Matrix. That would suck. Liquefied natural gas is a place to look, and affiliated plays. All right. Any questions on anything specific? Any specific companies that you're thinking you want to write covered calls? Nothing? CRNC. What is CRNC? I know zero about this stock. Is this the one you meant? Man, where did you get this idea from? What do they do? AI. Okay. Well, I hope you bought it here and not here. Chart doesn't love it. Is it on the weekly? Overbought on the weekly. So you have to have some really good fundamental reasons, and I don't know anything about these. You have to have some very, very legitimate fundamental reasons. This seems like it was gambling. Did you win? Are you up? AI-powered virtual assistants. Right. Because nobody else is working on that. Come on. I mean, does that look legit after it does that? Stock is probably not going out of business, but they're probably not going to do anything special. That's my guess. AI virtual assistant, please. Like there aren't literally 1,000 companies. Where do I stand on AMTX and ASTS? Same place I've been standing. AMTX is worth $1 billion right now, and it's probably worth 2 to 3 billion. Market doesn't care. Oh, look, they're not making money. They got capex, blah, 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 blah. They have $1 billion paid for a refinery. Their real estate in California is worth more than their debt. Those are facts. Now they have all kinds of RNG coming online. AST Space Mobile. Simple fact of the matter is Starlink revealed their hand. The best Starlink can do with their current constellation is give you text messaging on your cell phone if basically you hold your cell phone up and there's nothing above you. Can't do it from inside of a building. Probably can't do it from underneath a tree. So if your car flips over a rail and you're down in a gully, but it's heavy tree coverage, you have to crawl out from under the trees to get a text off. Apple has that too. There's nothing special about Starlink. AST Space Mobile is so far ahead of them. They're going to have a 5-year first mover advantage because the contracts they have are 5 years, and that's when the next CapEx cycle starts, 5, 6, 7 years out. They're going to have AT&T and Verizon business and Rakuten business and Deutsche Telekom and all the other business that they have lined up already, probably for the better part of a decade. And Musk fatigue is real. People don't trust it. If they can get it somewhere else for about the same price, for the most part, they're going somewhere else. Coinbase. Yeah. So I mentioned this one last week. I'd be selling covered calls and taking profits. On the ETF screener, when you flip this over, ARCW, there you go. ARC Next Generation is super overbought. Now, I think they still have some momentum. It hasn't flipped to sell here yet. But I think you're getting close on the Bitcoin miners, all the tertiary Bitcoin plays. I think there's probably a pause, maybe a small correction, a new narrative where everybody goes mental for a little while. I'd be real careful about all of these. Now, I don't hate Bitcoin for sure. I mean, I think it's a fine company. But if you're trading, I think you can sell covered calls on part of the position. Rocket Lab, it's going to $50 billion. Now, does that mean, oh, look, way back here, I said it was going to go to the moon, and look at that. Now look, I'm really right. I guess it's a heck of a rally, right? Heck of a rally. So, what's the market cap? About 12 billion right now, or is it 8 billion? I can't remember. But it's for sure going to be a $50 billion company. So the question I think you need to ask yourself is, think about what NVIDIA did. Think about what Palantir. I'm not selling any at this point. I think that selling some covered calls, if you want to lock in a little bit of money on part of the position, you could do. We talked about $30 and $40 covered calls last week. So, and you can write 2 of them, right? You don't have to write just one price point. You can get almost $2 on a 30, January 30, almost 75 cents on a 40. So I've got a handful of 30s and a bunch of 40s out there, but not against a big part of my position, just because why wouldn't I take a little bit of money with the idea that at those prices, I'd probably trim a little bit, right? And it really did take off last. So for a hot minute, we talked about this in chat. We thought these 30s were not quite right. So we thought maybe, oh, wow, we jumped the gun on that one like I did with AAOI. And I was just looking for a double on AAOI. I knew it was going to go up 400% in 3 months. Sometimes they get away from you. Oh, that reminds me, AAOI. Just want to remind you, for anybody who sold the December $20 covered calls, the June 25s are selling for basically the same price within a couple nickels and dimes. So roll your December $20 covered calls on AAOI out to June 25s, 5 into 20, that's an extra 25% you make for the next 6 months. The stock's at 40 right now. So that's what I've been doing. Just been rolling these out. Now, what I expect to happen during that time frame is that stock price comes down back into the 30s. And then I have a decision to make. Do I just let it get called away at 25? Or do I roll it again into the later part of the year? We'll see. My guess is that I'm happy to have these called away at 25. If the thing just keeps going up and up and up and up, then I'll just keep rolling it every several months. And eventually it'll be a 30, eventually it'll be a 35, eventually it'll be a 40. I mean, if this is a $100 stock and I didn't see it coming, I'll just be $15, $20 behind it the whole time. But I'll just keep on rolling up higher strike prices, and eventually it'll get called away at a profit. So you look for the strikes that'll get you about the same premium, what you're buying and what you're selling. So if you're buying back a 20 for $21 and $22, you're selling at 25 for $21 or $22, basically picking up almost $5 a share of appreciation. That's the benefit of rolling your covered calls out. And it doesn't matter that you're behind. Eventually, the market has a correction. And then you can buy it back in if you want, or you let it get called away. You decide. I don't think Applied Optoelectronics is anything more than a FOMO play right here. We were loading up around 11, 12, double our money. I don't feel bad about that. Could we have made more? Sure. But if you aren't being lazy, you learn how to roll your positions out, and you do that. So roll them out to the June 25s, which are about the same premium as the December 20s, right? Get the time value, get that $5 of extra appreciation, and then reevaluate the next time the stock price moves significantly, a couple months out probably. All right, have a wonderful day, and think about liquidity in the markets getting tighter next year, because that is a harbinger of a correction. Does it turn into an outright bear market? I think so this time. I don't think it'll be a horrible bear market. I think run of the mill, 20-ish% downside, similar to 2022. Still think the financial crisis is towards the end of the decade when we're at maximum Social Security and Medicare dependence. But, we'll see. I don't disagree with some of the things that Trump is doing long term. However, I have seen how deregulation and tax cuts that basically goes to the top 1 or 2% impact the economy 3 times in my life now, and kind of 4 times. I don't remember much from the 80s, but you can study. This recipe has failed every time. Every time it's a sugar high followed by a crash, hot money crash. And it takes several years to play out. In the meantime, you have to stick with your shorter term cycle. The shorter term cycle over the next year or two is just probably a pretty good hiccup. All right, take care.